Let's talk about cash value. How about that? Specifically, the mechanics of cash value in whole life policies for infinite banking. So, where does the cash value come from to begin with in a whole life policy designed for infinite banking? Does the face value or death benefit have anything to do with the cash value? How can the cash value be projected with certainty and guaranteed over many years into the future? Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I have focused on and specialized in the infinite banking concept and the tax-free cash growth warehouse finance strategy. So, without getting into the actuarial science of it and wanting to explain this very important aspect of whole life insurance, I'm going to explain the mechanics of cash value in whole life policies designed for using the infinite banking tax-free cash growth warehouse strategy as simply as I can. To start with, the cash value is derived from the total premiums paid into the policy. If a whole life policy is just straight whole life, not designed for infinite banking, there will be no cash value the first year, as all the premium goes to paying the cost of the insurance. Over time, the premium will provide an excess amount of over the cost of the insurance for the year, and that excess will go into the cash value account of the policy. That is because while the cost of insurance increases with each year as the insured grows older, the premium is calculated at the start of the policy, and an average cost is determined based on the projected life expectancy of the insured. That's also how premiums for term insurance is determined. So when a 10, 20, or 30-year term policy is purchased, the cost of insurance is averaged over the term of the policy. And that average amount becomes the annual premium amount charged each year until the policy expires. And that's how the premium can remain at the same level for the term of the policy. The cost of insurance is lower in the first year of the policy and increases each year. So if a term is for 10 years, the cost of the first year and each subsequent year up to the 10th is added together and then averaged out to produce the level premium for the whole 10 years. Obviously, the first 5 years, the premiums will be much higher than the actual cost of insurance, but the last 5 years, the premiums will be increasingly less than the cost of insurance. Now, with whole life, the calculation is similar, but quite often for a longer period of years, as the calculation is based on the projected life expectancy of the insured. There are more costs in the first years with whole life because even though the risk of the insured dying in the first few years is lowest, the amount of the death benefit presents a much higher risk of liability to the insurance provider if the insured were to die. And that risk of liability versus the amount of premium paid in decreases as the years roll on. So after the first year or two, there's a little bit of excess in premium that can then be put into the cash account of the policy. When that starts happening, the cash value begins to earn the guaranteed compounding interest. And from there, the cash value growth accelerates. Now, when a whole life policy is designed for infinite banking, first, it should be provided by a mutual company and be a participating life policy. That means it not only receives the guaranteed interest, but also receives dividends. Together, that's called dividend interest, and is generally a good deal higher than what non-participating policies pay, and it is compounding. Also, When a policy is designed for infant banking, it will be constructed with riders that contribute to the cash value. That is, the premiums for those riders contribute to the cash value. The primary rider incorporated with policies designed for infinite banking is the paid-up additions rider. This is a remarkable rider, really, because it not only adds to the total face value or death benefit of the policy, but most of the premium for that rider goes into your cash value and then receives the compounding dividend interest. Not only that, but while the size of the insurance policy increases, the amount of premium for the policy remains the same. And that's remarkable for a couple of reasons. One is that, as everyone knows, nothing is free, but with the paid up additions, you get more life insurance, and the premium paid for that mostly goes into your cash value. The other reason is that the amount of insurance or size of the policy is one of the major determinants of the price of the premium for the policy. And while the amount of insurance increases, the premium does not. With one company, the one I work with the most, there's another rider that contributes to the cash value the same way that the paid up additions rider premiums do. But this rider not only increases the size of the policy at a much lower premium rate, but it raises the MEC limit at the same time. That rider is a type of term insurance add-on. Again, the remarkable things about this rider is that it provides more insurance, and most of the premium for the rider goes into the cash value of the policy. So where a straight whole life policy has no cash value the first year, a policy designed with those two riders will have a good deal of cash value the very first year. And again, the cash value grows with the compounding dividend interest. So each year that the premiums are paid on the policy, a majority of the premiums for the riders are going into the cash value. And starting with the second or third year, part of the premium for the whole life portion of the policy is going into the cash value as well. And every year, that dividend interest is also added on a compounding basis, which means that the interest is also gaining interest. Often, people think that the size of the policy is what the cash value is based on, but that's not the case. Certainly, the size of the policy is connected, but only in that the amount of premium is partly based on the amount of insurance. The age and health of the insured are the other two major factors in determining the amount of premium. And it's the premiums paid into the policy along with the dividend interest that create and contribute to the cash value. For example, a 60-year-old male in standard good health and non-tobacco user can get a whole life designed for infinite banking in the amount of $200,000, and the premium will be about $6,000 per year. That'll give his cash value at the end of the first year of about $3,000 or 50% of the premium for the year. A 30-year-old male in standard good health non-tobacco user can get a similar designed policy in the amount of $675,000 for a premium of just $4,000 per year and have only $1,631 in cash value at the end of the year. So it's not the face value or size of the policy that determines the cash value. It's the premium. Most likely, I would not design a policy with that high of a face value for the 30-year-old wanting to do infinite banking. I would construct a policy with a lower face value and higher amount of paid up additions instead, and giving him much more cash value. This example was just to highlight that it's not the face value that determines the cash value. So what I did actually is I made the rider, the paid up additions rider for both the 30-year-old and the 60-year-old, the same amount per year, which I believe was $700. And then the term rider portion at a similar percentage to the total or to the whole life portion. Anyway, it's again, it's not the size of the death benefit that determines the cash value. It's the premiums and then the compounding dividend interest. So it's the design of the policy with the cash value riders that determines the premium and creates the cash value of the account, and the compounding dividend interest that accelerates the growth of the cash value. Okay, if you found this to be helpful, please hit the like button on this video and subscribe to this channel. Also, please post your questions and comments here. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also below. And if you'd like to apply to become a client of ours, the link to the application is below. We're here to help. We look forward to helping you. So for now, aloha and mahalo for watching.